All eyes are on the Bank of England as regulators investigate the FX rigging scandal. Here to share his insight is Dean of Warwick Business School and former foreign exchange trader Mark Taylor. Mark, what was your initial reaction when you heard about this scandal?
It was not surprise. I think it's been known for some time that there are efforts to not rig, but certainly to affect the 4 p.m. fix, which is the main reference rate in the foreign exchange market that this investigation is centred on. And as a former foreign exchange trader myself, it is part of the folklore of the market that in fact traders do try and affect that reference rate. And in one way, I suppose there is some surprise that it's taken the Bank of England so long to investigate it.
So how much of the blame should the Bank of England shoulder?
The Bank of England does have oversight of the financial markets. The London financial market is the most important foreign exchange market in the world. Most foreign exchange transactions are booked through that market. It does share some responsibility. I think that's true.
Let's focus on Governor Carney's decisions that he's made of late. He said he's appointing new deputy governors to the bank. He's promised to bolster internal regulations, but do you think those changes go far enough?
I think they do in some sense. And obviously there has been a culture in the foreign exchange market and in the bank of not being forensic enough about the way the foreign exchange market conducts its business. So letting people push through big trades at just 30 seconds or 20 seconds before the reference rate is fixed in order to affect that rate and create a situation where they can take an unfair profit from their clients. Even if there's the whiff of that, it should have been looked at some time ago. Mark Carney has brought in two very, very experienced new deputy governors, Ben Broadbent and Nemat Shafik from the International Monetary Fund, with responsibility for conducting a root and branch review of the way the bank uses market intelligence and investigates these issues. So that is a very, very important issue, I think, and it's an important step forward. It depends what will come out of that. To my mind, it's not really so much regulating the market that's important. It's actually taking away the incentives for people to cheat in that market. And therefore, there are one or two ways in which the 4 p.m. reference rate is fixed, is calculated, that I would like to see change in order to take away that incentive for big traders in the market to try and influence that and get an unfair advantage over their clients. Mark Carney, this didn't happen on his watch. He's trying to change the culture of the Bank of England. So bringing in two very, very, very senior deputy governors in order to deal with that is an important step forward.
Regulatory action is what he's calling for, but do you think a criminal investigation against the traders who have been suspended is also needed?
Well, I suppose one has to go back and examine exactly what are the allegations, what is it that's being alleged. Now, there is a reference rate in the market which goes for all the major exchange rates, dollar sterling, dollar euro, dollar yen. At 4 p.m. there's a rate that's calculated every day by Reuters, a private company, and it's calculated by taking the average exchange rate for transactions recorded by Reuters for 30 seconds before 4 p.m. and 30 seconds after 4 p.m. And that average is then called the 4 p.m. fix. Why that's important is that many big institutional investors, many big clients of banks may have lots of foreign exchange transactions going through, and they'll just say to their bank, well, just do them at the 4 p.m. fix, just do them at that reference rate. So if the bank is able to affect that rate and push it up artificially high, just for a minute or so around 4 p.m, they can then charge their customers a higher rate than is actually the true rate in the market. You could put through your big trade, a couple of $1 billion, 20 seconds before 4 p.m. That in itself is not illegal. If somebody said, why have you put through that big trade? I said, well, it's not illegal to trade, obviously. But what is illegal is colluding, right? If there is evidence that banks got together, or big, senior traders from some of the big banks got together and said, I'm going to put through this $1 billion trade, dollar sterling, I'm going to buy dollars against sterling at 10 seconds before 4 p.m. Why don't you do the same thing? And we can both together affect the market rate. That would certainly trigger a criminal investigation, possibly criminal charges. And that's why important evidence to examine here is the chat room evidence. There is some suggestion that some of these traders may have spoken to each other online in text room chats, chat rooms with Bloomberg and Reuters. And if there is evidence recorded there of collusion deliberately to affect the market, then that is a criminal offence.
When speaking before Parliament's Treasury Select Committee, Carney said he had no information that suggests that anyone at the Bank of England condoned manipulation of the market, facilitated or participated in market manipulation. He also went on to say that we have to protect the integrity of the market. But if we have the belief that traders colluded, what does that do to general market stability?
I'm sure it's true that no one at the bank did participate or condone. I'd be very surprised if that was the case. I suppose it's more a matter of culture. The bank should have been aware that, if you just look at the behaviour of exchange rates, just look at what happens around 4 p.m. They tend to spike, well, they have historically tended to jump up for 30 seconds or so around that time. So the question is, that in itself is kind of prima facie evidence that people are trying to affect that rate. And I think Paul Fisher, when he was examined along with Governor Carney at the Treasury Select Committee, did say something like, well, it's not the bank's business to go out hunting down FX market riggers. Well, maybe it is. Maybe they should, where there is at least prima facie evidence of that, where it's part of the folklore, in a sense, of the market, that everyone kind of knows that people are doing this. They should perhaps have investigated it, rather than seeing it as part of the culture of the market.
How do we avoid this becoming a second LIBOR affair?
The LIBOR scandal was very important. It did strike at the perceived integrity of the financial system, and this does so similarly. It is very, very worrying. And remember, the banks will be taking a profit from their institutional clients, but who are those institutional clients? They're largely pension funds. So insofar as profit is taken from pension funds, it's taken from every one of us who have an investment, either direct or indirect, in a pension fund, and we'll have less money to spend in our retirement. So it is something that is vitally important to all of us. I think just regulating the market and saying you shouldn't do this is very difficult, because financial markets are by their very nature large, opaque. The foreign exchange market is by definition an international global market, a $5 trillion a day market. So very, very hard to regulate, because the markets will tend to find ways of circumventing that regulation. I mean, one simple way of dealing with it, or one way I personally think should be investigated, is the way the 4 p.m. fix is conducted. And the problem with the 4 p.m. fix is that you only have to move the exchange rate a small amount for a small period in order to affect it. So if you can affect the average rate by a fraction of a percentage point, then that can represent millions of dollars of profit on a billion-dollar trade. Now, one simple way that ought to be investigated perhaps is to calculate the average rate over a whole hour rather than 1 minute, because it'd be very difficult in a $5 trillion a day financial market to affect that average over a whole hour rather than just a minute. Another alternative would be, if you want to take a short interval, you could take a minute interval, but take it a random 1 minute interval between 30 minutes before 4 p.m. and 30 minutes after. So that would then take away the incentive or the opportunity for traders to try and front run or affect the 4 p.m. fix. And I think that will be far more effective than just regulating against it.
How likely do you think it is for the Bank of England to take your suggestion?
Well, I don't know, and they haven't spoken to me about it, but I'm open to conversations about it, certainly.
Now, let's talk about legacy concerns. Of course, when Governor Carney came into his position, there was a lot of expectation placed on him. What does this whole scandal do to that expectation and his legacy? In a sense, it wasn't, well, not in a sense, it's absolutely, this didn't happen, this didn't occur on his watch. So it's not something that he's certainly to be blamed for. He's called in an external company, a law company, to investigate this. He's appointed 2 new deputy governors of very, very high standing in the international financial community, one ex-Goldman Sachs, one ex-International Monetary Fund, to investigate this. So I think those are very, very strong and bold moves. So I think he's doing actually very well out of this. It depends what comes out of that investigation, the external legal investigation. It depends what comes out of the internal root and branch review that Nemit Shafik will conduct, and the new measures put in place both to shift the culture of the bank and in order to put in place new ways of calculating the 4 p.m. fix. Well, I'll be watching. Thank you so much.
Thank you.